there's a price differential between cash bonds. Let's say a 2-year bond you can buy for X amount of money, and a futures you can buy for a little bit. It's a little bit more expensive, like by fractions of a penny. One of the reason is that you can get exposure to the same securities, what's legally the same thing, but you only put up a fraction of the money to get that same exposure. Like, for example, when you buy a gold futures contract, you have exposure to 100 ounces of gold, but you only put up what is it, like a few percent margin? I forgot what the exact number is, but it's in the single digits, I think. Let's just say 10%, I don't know. So you have to put up less money to get that exposure. So for bonds, that means that the futures, the nearest future bond contract is cheaper than the cash bond contract. So not the actual cash bonds that you buy, like the paper. So what hedge funds will do is basically sell the futures and then buy the paper to cover, so it's so it's not a naked short, and then they wait for the futures contract to expire, and then it converges on the cash price, and then they are able to net a fraction of a penny on that trade. So a fraction of a penny is not going to get you that much money. So what you have to do is you have to borrow like hundreds of billions of dollars in the repo market and do it over and over and over and over again. And then you can multiply that fractions of a penny by many millions of times, and you end up with, I think one of these hedge funds ended up with a profit of 1.5 billion or something like that. So whether that's all from the basis trade or whether it's just a few $100 million, it's basically free money if everything doesn't crash. Then the thing that could go wrong with it is if there's not enough money in the repo market to cover the trade that they need to cover for that day, then repo rates can jump up to, let's say, what happened in the repocalypse, like 10%, and then all of a sudden their costs of executing the trade exceed their profits from it, and then they have to unwind everything really quickly. And then what happens is, like, the funds that were short the futures, all of a sudden they have to buy it back really quickly, so the price of the futures shoots up as they have to cover it, and then interest rates on the 2-year go down, but interest rates on the repo go up, and then you have this like jagged action on the yield curve that messes up pretty much every derivative that's based on it, which is like interest rates for everything from renting a car to mortgages, etc.
In today's episode, Rafi Farber highlights how in 2024, a looming financial crisis seems inevitable as savings dwindle, production stalls, and the market increasingly relies on speculative financial trading. The practice of basis trading, where hedge funds sell futures and purchase paper bonds, creates a fragile ecosystem susceptible to instability, especially when repo rates surge. The Federal Reserve's quantitative tightening further strains the liquidity in the repo market, raising concerns about a potential crisis. While some expect the Fed to ease by lowering interest rates, the situation remains precarious. Rafi highlights how, as uncertainty looms, precious metals like silver emerge as a refuge of value in a world where traditional currencies may falter. To weather the storm, building trust within local communities and seeking out reliable assets becomes crucial as the financial landscape of 2024 takes on an increasingly uncertain hue. Hit the like button, smash the subscribe button, and turn on notifications so you do not miss out on our daily videos. And check our pinned comment for some massive sign-up bonuses.
Dry up. That's inevitable because the Fed continues to suck liquidity out of the market with its quantitative tightening, which means it's selling bonds into the market and taking cash and retiring it out of existence. So that means there's less cash in the market. And the reverse repos really come into play here because the reason the reverse repos exist is because the banks can't lend to anyone else at that same rate. Why are they lending cash to the Fed for 5.3%? Because they can't find anyone to lend money to at a rate higher than that. So they can't loan the money, which means new credit can't be created because interest rates are too high. And that's because of quantitative tightening and the money supply is shrinking. So at some point, there's not going to be enough money in the repo market to supply all of these basis trades, right? If you're going to take money out of reserve, if you're going to take money out of existence, if you're the Federal Reserve, sooner or later, there's not going to be enough money. And because the banks can't create new credit on their own terms with their own balance sheets, because we see from the reverse repos that no one's taking any loans, right? Otherwise, there wouldn't be reverse repos. Then at some point, there's not going to be enough cash, and there's going to be something like a repocalypse. It might not be exactly like what we saw in September 2019. It could be that the Fed is already ready, to act on it before interest rates shoot up. But we would see that in the balance sheet. Like, they have a standing repo facility where they are ready with their fingers on the triggers to supply dollars to the repo market in case it needs, so that interest rates don't jump up like they did in 2019. But either way, it's not really the interest rates that matter so much as the fact that the Fed will reverse quantitative tightening to quantitative easing. And if you remember, in 2019, around August, September, a little bit before the apocalypse, that is when gold broke out of its 6-year trading range that it was in since the crash of 2013, right? 2013 to 2019, it was stuck in a trading range, and it broke out just before the apocalypse. Whether that's serendipity or coincidence, or it's the gold market sniffing out what's happening in the short-term interest rate markets, it could be that. So I would look for a repocalypse pretty soon, probably when the reverse repos run out, and gold is already breaking out of its, 3-year trading range if we count the August 2020 top. Let's say loosely 2100, 2150 is a break of that. So we're on the verge of that. My prediction is that when quantitative tightening ends and we have the next quantitative easing, that'll be the first phase of the money printing, and we'll see gold break out to a new range. And then when it gets really serious and they have to print money outright, that's when gold could really go vertical and the dollar could end,
Silver prices are down on Monday, primarily due to a stronger U.S. dollar and fading expectations of an early Federal Reserve rate cut. The price drop reflects reactions to last Friday's robust U.S. non-farm payrolls report, which impacts broader market sentiment regarding the Fed's current policy. Spot silver is trading at $23.04, down 0.67%. This decline is in tandem with a rise in the U.S. dollar index and Treasury yields, both influencing silver's affordability and attractiveness. Beyond the immediate labor market data, silver has faced challenges for weeks due to competing investment flows into cryptocurrencies and equities. The labor market's robust performance, demonstrated by a surge in hiring during December, has shifted market expectations significantly. The likelihood of the Federal Reserve implementing a rate cut in March has decreased to approximately 64%, down from a high of 90% in late December. This shift is of utmost importance as it directly influences the investment strategies of individuals interested in precious metals such as silver and gold. Looking ahead to upcoming economic reports, investors are currently closely watching this Thursday's U.S. consumer price inflation report to gain further insights into the Federal Reserve's future rate decisions. The anticipation of this report, combined with the current economic landscape, is placing downward pressure on silver prices. Now we'll show you more clips of Rafi Farber, but first, subscribe and turn on notifications to keep us motivated to bring you more videos like this. Enjoy the video.
Look at the shape of pretty much any of the parabolic curves, whether you measure that by federal debt deficits, or the money supply, or the Fed's balance sheet following an exponential curve since 1913. It's all the same curve. So, at some point it just gets too high, too fast. And if I can triangulate it with how non-productive society appears to be at this point in our history, then and if we assume, which I do, that inflation and societal sanity, let's call it, are proportional, then I don't see how we can continue to function this way when systems are becoming so obviously corrupt that anything beyond this, if the inflationary system can sustain itself for, say, another 5-10 years, we could get into a situation where we have real global tyranny that looks like something out of the Soviet Union or Nazi Germany, something like that, all over the world. And that's not a world that I'm prepared to live in. So call it a prayer and me banking on the shape of parabolas, but I don't see this going much longer because people are being driven crazy. And nobody has any savings anymore. So production is being sucked into oblivion. And eventually when we can no longer produce and we're busy just like making money through basis trades, shuffling paper, and that's where the money's coming from, and nobody's producing anything anymore, then how can this continue? I don't see it. At least I really hope it doesn't last another 5 years, because I don't know if I could take it.
What do you think of today's show? Do you agree with Rafi Farber and the impeding debt crisis? Will America financial system collapse faster than anyone expects? Post in the comments section down below your insights on the matter. Thanks for watching the video to the end. You're the backbone of our success. That's it for today, Dean, and I see you on the next one.